Hello, Money Mavens! Today, we're diving into the exciting world of investing. You see, while tucking your hard-earned dollars into a savings account is a good start, it's just not enough to build substantial wealth. Why? Because savings accounts offer low interest rates that can't quite keep up with inflation, causing your money to slowly lose value over time. Investing, on the other hand, can provide a higher potential for growth, enabling your money to work harder for you. To step into the market and start buying stocks, bonds, and other assets, you'll need to open an investment account. So, if you're ready to turn your savings into growth, it's time to take a closer look at how to invest your money. Now, let's start with the basics. In the investment world, stocks and bonds take center stage. But what are they exactly? Stocks, also known as shares, represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company. If the company does well, its stock price may rise, and you stand to make a profit if you sell your shares. However, if the company underperforms, its stock price could fall, and you could potentially lose money. Stocks therefore carry a level of risk, but they also offer the potential for high returns. On the other hand, bonds are like loans. When you buy a bond, you're essentially lending money to a company or government for a fixed period. In return, you receive regular interest payments during the bond's term. At the end of the term, the bond issuer repays the original loan amount. Bonds are generally considered safer than stocks because you're guaranteed to get your money back, along with interest, unless the issuer defaults. However, the trade-off is that bonds typically offer lower returns than stocks. So, stocks and bonds each have their perks and pitfalls. Stocks can offer more growth, but with more risk. Bonds offer less risk, but with less growth. It's like a financial seesaw. Remember, investing is not a one-size-fits-all approach. It depends on your financial goals, risk tolerance, and investment timeline. You've probably heard the saying, "Don't put all your eggs in one basket." Well, this applies to investing too. Diversification in the context of investing is much like that wise old saying. It's all about spreading your investments across a variety of assets like stocks, bonds, and others. Why, you ask? Simply put, it's about risk management. Imagine you've invested all your money in one company's stock. If that company goes under, so does your investment. But if you've spread your investment across the stocks of 10 different companies, the poor performance of one might be offset by the good performance of the others. Think of it as a seesaw. On one side you have potential losses, and on the other, potential gains. By diversifying, you're trying to keep that seesaw as balanced as possible. You spread your investments across different asset types, industries, even countries, all in an effort to smooth out the ups and downs of the market. But remember, while diversification can help manage risk, it's not a magic shield. It doesn't guarantee profits or ward off losses. It's simply a strategy, a way to play the game of investing with a bit more balance and a bit less risk. Diversification doesn't guarantee profits or protect against loss, but it's a key strategy for managing risk in your investment portfolio. Investing isn't about getting rich quick. It's a long-term game. Now let's dive into the heart of the matter. When it comes to investing, patience is indeed a virtue. The temptation to pull out your investments at the first sign of a market downturn can be strong. But resist. Remember, investing is a marathon, not a sprint. Steer clear of those flashy, get-rich-quick schemes. They might seem attractive, but more often than not, they're just smoke and mirrors. True wealth is built slowly over time through consistent and calculated investments. It's about steadily growing your wealth and letting the magic of compound interest do its work. This is not to say that you should completely ignore short-term market fluctuations, but don't let them dictate your investment decisions. Instead, focus on your long-term goals. Are you saving for retirement? A down payment on a house? Your child's college education? Keep these goals at the forefront of your mind and let them guide your investment strategy. Patience, persistence, and discipline are key in the world of investing. So remember, it's not about timing the market, but time in the market. And that's a quick primer on how to invest your money. We've covered the crucial role of investing in building wealth, the ins and outs of stocks and bonds, the importance of diversification in reducing risk, and the need to maintain a long-term strategy for sustainable gains. Remember, it's not just about saving. Investing is a necessary step towards financial freedom. So, tell us, which investment habit will you work on first? Leave your answer in the comments below. And remember, your financial future is in your hands.